Last week, I logged into my credit card account. Before I could check my balance, before I could review my transactions, a message appeared. Update your annual income to improve your experience. Improve my experience. That phrase sounds helpful, customer-friendly, almost thoughtful. But when a bank asks for information, it's rarely about improving your experience. It's about improving their model, and your income is one of the most powerful inputs in that model. The normalization effect banks have made income disclosure feel routine. Just another form, just another box, just another harmless update. But income is not harmless data, it's predictive data. The moment you enter that number, you're not just sharing what you earn, you're helping them calculate how much credit to extend, how much risk to tolerate, how aggressively to market to you. And most importantly, how much profit you represent. Not how responsible you are, not how disciplined you are, how profitable. That difference changes everything. Income as a signal. When you tell a bank your income, you send a signal. That signal feeds into automated decision systems. Those systems categorize you almost instantly. If your income is high, the model may assume you can handle more debt. You are less rate sensitive. You are a candidate for premium products. If your income is lower, the model may assume you are more price sensitive. You may need credit building tools. You represent a different marketing strategy. Either way, the number becomes a sorting mechanism, and once sorted, your experience changes, often without you realizing it. Higher income often leads to higher credit limits. That sounds positive. More flexibility, more purchasing power, more financial breathing room. But higher limits also increase exposure. A larger limit increases the psychological comfort of spending. It widens the runway for debt accumulation. Banks know this. Statistically, customers with higher limits tend to carry higher balances over time, and balances generate interest. Interest generates profit. A higher limit isn't just generosity, it's potential yield. There's another layer most people never see. You might assume interest rates are purely about risk, but pricing models also factor in behavior and likelihood to switch. If you earn a high income and historically stay loyal to your bank, the algorithm may conclude you're unlikely to leave over small pricing differences. That means you might not receive the most competitive rate available, not because you're risky, but because you're stable. In financial modeling, this is often tied to ability to pay logic. If you can absorb higher costs without friction, the model may test those limits. Your earning power becomes part of the pricing equation. Income also fuels marketing intensity. Higher income customers are often targeted with premium credit cards, high annual fee products, investment services, wealth management upgrades. Lower income customers may see balance transfer offers, installment loans, credit building products, different bracket, different strategy, same goal, revenue optimization. The data you provide doesn't disappear into storage. It activates campaigns. It determines which banners you see when you log in. It influences which emails land in your inbox. Your income shapes your digital environment. Now here's the key question. Are you required to provide updated income information every time it's requested? In many cases, no. There are legitimate scenarios where income disclosure is mandatory. Mortgage underwriting, certain loan approvals, regulatory compliance situations. That's understandable. But periodic update your income prompts on existing accounts are often optional. Declining to update isn't dishonest, it's selective disclosure, and selective disclosure is a strategic decision. The asymmetry problem. Consider the imbalance your bank already knows, how often you spend, where you spend, whether you pay on time, how much debt you carry, how long you've been a customer. They analyze this behavioral data constantly. You, on the other hand, know very little about how their internal algorithms classify you. When you provide additional income data, you reduce their uncertainty. Reduced uncertainty allows more precise targeting. More precise targeting increases profitability. Data asymmetry benefits the institution. Limiting optional data narrows that gap, even slightly, when updating makes strategic sense. This isn't about refusing information reflexively, it's about aligning disclosure with your objectives. Updating income can make sense if you want a higher credit limit and your earnings support it. You're applying for a new loan and need stronger approval odds. You're negotiating terms that depend on repayment capacity. In those cases, disclosure benefits you. But if you're content with your current limits and terms, if you're not seeking new credit, if stability matters more than expansion, there may be no reason to refresh that number. There's something powerful about behavioral consistency. If you pay on time every month, keep utilization low, avoid unnecessary debt, maintain long account history, that data becomes your financial fingerprint. Behavior is harder to manipulate than stated income. Income fluctuates, behavior compounds. Over time, disciplined behavior often shapes risk assessments more reliably than self-reported earnings. The psychological pressure. There's also psychology involved. Financial institutions design requests to feel official. Pop-ups feel urgent. Forms feel required. The tone feels authoritative. Most people comply automatically, not because they've evaluated the request, but because it feels expected. Pausing disrupts that pattern. You can close the prompt, you can ignore the request, and nothing dramatic happens. No penalties, no shutdowns, no score damage, just the absence of fresh data. Economic downturns and data use. During economic uncertainty, banks reassess portfolios. They review accounts. They adjust limits. They manage exposure. Income data becomes part of that assessment. High-income customers may retain larger limits. Lower-income customers may face precautionary reductions, but behavior still plays a critical role. Payment history often outweighs static numbers during stress cycles. Again, behavior compounds. This conversation extends beyond banking. Every institution collecting your data is optimizing something. When they say, to improve your experience, it often means to refine our model. That doesn't make institutions malicious. It makes them rational. Profit-driven entities optimize. Understanding that allows you to respond intentionally rather than automatically. Here's a simple mental filter. Provide income when it is legally required. It strengthens your application. It unlocks something you genuinely need. Decline optional updates when you gain no advantage, you prefer predictability. You're not seeking expanded credit. Intentional disclosure builds leverage. Automatic compliance reduces it. The next time you log in and that income update box appears, don't react immediately. Pause. Ask, is this necessary? Is this beneficial to me? Or is this just fresh data for someone else's optimization model? You don't need conflict. You don't need distrust. You just need awareness. Because in finance, information flows one direction by default. Understanding that flow allows you to decide how much of yourself you contribute to it. And that decision, quiet, small, deliberate, is a form of leverage. Used wisely, it shifts power back into your hands.